Hey, welcome back, everybody. I'm going to be doing COMM 217 Chapter 2 Investing in Finance Decisions and the Accounting System. So, on the left side here, we have our legend. So, anything I highlight in yellow will be our chapter titles or our main points that I'll be describing shortly. In blue, it's our heading. So, anything just right under it, that's also part of the chapter title, and then green is our subheading. So in case you see a lot of blues, a lot of greens, they're all part of the same chapter. So here, number one, defining the objective of financial reporting. So let me highlight that. Financial reporting, qualitative characteristics of accounting information. So qualitative characteristics. And the related key accounting assumptions and principles. So accounting assumptions and principles. So that's for number one. Number two, define the elements of a classified statement of financial position and analyze how the information is relevant to investors and other decision makers. So let me do analyze information. So number three, identify what constitutes a business transaction and recognize common account titles used in businesses. So business transactions is for number three. Four, apply transaction analysis to simple business transactions. Asset equals liabilities plus shareholders' equity. So I'll explain what this means, but this is very important in accounting. Number five, determine the impact of business transactions on the statement of financial position by using two recording tools. You have your journal entries and T accounts. And journal entries. And I believe if you're in COMM 217 taking it after 2023, they did tell us that journal entries aren't going to be on the exam anymore. So we'll primarily focus throughout the other chapters on T accounts. And I believe journal entries is just not a thing anymore that we're going to be covering. So, six, prepare a trial balance in a classified statement of financial position and analyze the company using the current ratio. So, a trial balance, classified statement of financial position. So, seven, identify investing and financing transactions and demonstrate how they are reported on the statement of cash flows. So, that is our main point. So, let's get into the actual chapters. So, our chapter investing in financing decisions and the accounting system. So, number one here is an organization of the chapter. We have our overview of the accounting concepts. We have what types of businesses, activities. This is pretty much what I explained before. So, one, overview of accounting concepts. So let me zoom in. So, one, an understanding of the accounting concept will be helpful as you study because learning and remembering how the accounting process works is much easier if you know why it works. So I'll highlight that. So, accounting process, why it works. So, a clear understanding of these concepts will help you in the future chapters as we examine more complex business activities. So, here are the concepts emphasized in chapter 2. So, we have objective of financial reporting. The primary objective of external financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors. So, external financial reporting provide financial information useful to investors, lenders, and other creditors in making decisions. And creditors. So, financial reports must allow decision makers to assess the amount, timing, and uncertainty of future cash inflows and outflows, but also to understand value of assets owned against liabilities and equities. An example of this is creditors and potential creditors need to assess an entity's ability to pay interest on a loan over time or to repay the initial amount borrowed, that is called principal. So, qualitative characteristics of useful accounting information. To fulfill the primary objective of providing useful information, The conceptual framework is the exclusive authoritative source of standard and guidance. The conceptual framework states 6 essential characteristics of accounting information. So let me highlight that. That makes it useful to decision makers. 2 fundamental qualitative characteristics, and then 4 enhancing qualitative characteristics, which the 4 are described here: comparability, verifiability, timeliness, and understandability. The 2 fundamental qualitative characteristics are relevance and faithful representation. So let's dive into that. So relevance, it's information disclosed in financial statements is relevant information if it can influence users' decisions by helping them assess past activities or predict future events. Predictive value, this is an estimate or projection of a financial or accounting metric based on data and various assumptions. Confirmatory value is a value that confirms or changes to prior expectations based on previous evaluations. Comparing predicted results with actual results will be helpful in providing the quality of the prediction process. So faithful representation, this is the one on the right. To be useful for decision making, information provided in financial statements must be faithful representation of the economic phenomenon it is supposed to represent. An example of this is cash collected in advance of delivering goods that is recognized prematurely as revenue for the period overstates the amount of revenue reported on the statement of earnings, causing a lack of faithful representation of the current period revenues. So we have bias here. The usefulness of accounting information is enhanced when it is free from bias in its measurement and presentation. Bias occurs when the item being measured is consistently understated or overstated. An example of this is liabilities should result in an understatement on the statement of financial position, because this would favor owners over creditors and may influence investment and credit decisions of financial users. So let's talk about the 4 enhancing qualitative characteristics. So comparability. Comparability enables users to identify similarities and discrepancies between 2 sets of financial reports produced by different companies. Changes in accounting methods reduce the comparability of information. Verifiability, it is information presented is verifiable if independent accountants can agree on the nature and amount of transaction. An example of this is historical cost of a piece of land that is reported on a company's statement of financial position at year end is usually highly verifiable. So timeliness. Information that is not available in a timely manner loses its relevance. Companies produce quarterly reports and issues press releases to convey information in a timely way to investors, creditors, and other user groups. Understandability. Information cannot be useful if it is not properly understood. Understandability means that quality of information that enables users to comprehend its meaning. So these are the 4 qualitative enhancing characteristics, and I just explained the 2 fundamental qualitative characteristics. So constraint of accounting measurement. Accurate interpretation of financial statements require that the statement's reader be aware of an important constraint of accounting measurement. We have cost constraint. Information should be produced only if the perceived benefits of usefulness exceeds the expected costs. So I'll highlight that. So if the perceived benefits exceed the expected cost of providing that information. Managers may voluntarily disclose information about a specific aspect of the company as long as the cost of disclosure does not exceed the expected benefits. So I'll highlight that again. Cost of disclosure does not exceed expected benefits. Cost constraint plays an important role in determining whether new information should be produced and communicated to users. So recognition and measurement concepts. We should consider 3 assumptions and a measurement concept that underlie much of our application of these definitions. We have separate entity assumption. This assumption that states that the activities of each business must be accounted for separately from the activities of its owners, other persons, and other entities. An example of this is a building purchased by the owner of a real estate development and management company for personal use should not be mixed with the buildings owned by the company. So, this is pretty much saying that you must separate the entity of the company and the entity of the, let's say, owner of that company because they are two separate entities. Stable monetary assumption states that accounting information should be measured and reported in the national monetary unit. An example of this is pretty straightforward. Canadian dollars is used in Canada. Euros is used when information is being converted or shared in European countries. Same thing with pesos in Mexico, etc. So the stable monetary unit assumption allows accountants to combine dollar amounts from various years, even though the purchasing power has changed over time. Continuity assumption. This states that businesses are assumed to continue to operate into the foreseeable future. Violation of this assumption means that assets and liabilities should be valued and reported on the statement of financial position as if the company were to be liquidated. In all chapters of this book, we assume that the businesses we encounter and use as examples meet this continuity assumption. So, mixed attribute measurement model. MAMM is an accounting approach that combines different measurements bases for various items on a company's financial statements. You have two primary measurement bases. You have historical cost, which is the recording assets at their original purchase cost and subsequently adjusting for depreciation, amortization, I don't know if I said that right, and impairment. Recording liabilities at an undiscounted amount required to settle them. An example of this is property, plant, equipment, financial assets, and liabilities. So I'll highlight that at the original recording assets at the original purchase cost. And this is important to realize that there is an original cost because there's also a fair value cost, which I'll explain right now. So fair value is the amount at which an asset could be bought or sold in an arm's length transaction between willing parties. So that's the difference. It's the amount at which an asset could be bought or sold. So fair value represents the current market value. So an example of this is marketable securities, financial derivatives, certain financial instruments. So 2, elements of the classified statements of financial position. So first we have our assets. It is an economic resource controlled by an entity as a result of past transactions or events. So economic resource controlled by an entity. Economic resource is a right from which future economic benefits may be obtained. Assets are the resource that the entity controls and can use in its future operations. So I'll highlight that as well. Resource that can be used in its future operations. So an example of this is Gildan, using the Gildan company. Gildan cares about its assets because they embody future financial benefits. Gildan's assets and their productivity are the basis upon which they can generate forecasts about how readily the company can repay its financial obligations. For Gildan's shareholders, the increase in the value of their investment will depend in the large part of the future benefits arising from assets. To make financial statements more useful, classifications of information are included on the statements. So here is an example of the Gildan's Activewear Incorporation. It's the consolidated statement of financial position. This is pretty much what this whole green body is. So we have our assets and the dates, so all of that. So I'll explain everything right under. So Gildan's simplified statement of financial positions. This is the whole green box. This notices the title of the statement, Consolidated Statement of Financial Position. That's what I've said before. Consolidated just means that the elements of Gildan's statement of financial position are combined with those of other companies under its control. There are two amounts are shown, one from January 3rd, 2021, and the other is from December 29th, 2019. So make sure you're aware that some prices of the days are shown differently. This allows investors to compare at a glance the value of each element from year to year. Assets are listed first, followed by liabilities. So you can see assets here, liabilities here, and then shareholders' equity is right here. So let's talk about assets of a company. So assets of a company include the following. One, you have your current assets, which is short term. So I'll highlight that in pink. So your current assets are short term. This could be cash, short term investments, accounts receivable, inventories, prepaid expenses, or other current assets. Non current assets are long term. So these include property, plant, and equipment, financial assets, intangible assets, goodwill, and other assets. So let's explain these. So cash appears first because it is the most liquid asset. Cash is pretty much the cash that the company has to use for future purchases. Short-term investment represents the reported values for shares of the other companies. Receivable represents an amount of money owed to the company. An example of this is owing money to Gildan. If we owed money to Gildan, that Gildan will report that as an accounts receivable because they will be receiving money in the future. Accounts receivable are amounts owed by customers who purchase products and services on credit, normally collected within 1 year of the statement's due. So inventories refers to goods that are one, held for sale to customers, and two, are used to produce goods or services for sale. So inventory is considered a short-term or current asset because it is something that is going to be sold hopefully in the upcoming year. And as we said, it's held for sale to customers and it's used to produce goods or service for sales. So let's explain non-current assets. So this is the long term. So non-current assets are also called fixed assets or capital assets. Non-current assets have a physical form you can touch. Each asset is tangible. Example, like I said before, property, plant, and equipment. This includes all land, the business, buildings, machinery, and equipment such as tools, furniture, and other fixtures for the production of the company. Intangible assets directly related to the operations of the business. An example of this is franchises, patents, brands, trademarks, copyrights, and computer software. An example of this is Gildan again, using customer contracts, using their trademarks on their shirts, and computer softwares to do any data, to manage any orders, and all of that. Goodwill is an asset that arises when a company purchases another business to control its operating, investing, and financing decisions. An example of this is the 207 resulted from the acquisition of comfort colors such as American Apparel and Comfort Colors from Gildan. So I believe if we check up here and we see Goodwill, I'll highlight that in purple. Goodwill here, 207. We could see it's under non-current assets. And it's 207 because what we said, the acquisition of Comfort Colors and American Apparel. Other assets are pretty much just relatively small values that are long term. So liabilities of a company, this presents the debts or obligations of the entity to transfer economic resource because of the past events. The liabilities of a company include the following. We have one, current liabilities, which is short term. So what did I highlight? So I'll highlight that in pink again. So so in current liabilities, which is short term, we have accounts payable, short term debt, income taxes payable, we have accrued liabilities, provisions, other current liabilities. So that's pretty much it for current liabilities. Don't worry, I'll explain what all of them mean right underneath in green here. Two, non-current liabilities or long term. So I'll put that in purple. So long-term debt, provisions, and other liabilities. So here it's long-term provisions. It's supposed to be for B. So current liabilities is short-term obligations that will be settled within the coming year by providing cash, goods, or current assets or services. Short-term debt, it represents short-term loans from banks. Many companies take a loan from a bank and then they would report it in the short-term debt because they would have to repay the banks with interest rates and anything like that. Income tax is payable. It's simply an estimate of the amount of taxes a company is expected to pay to taxation authorities. Provisions, it's an estimated liabilities that are expected to be paid within 1 year, but the exact amount and date of payment are not known with certainty. Non-current liabilities, long term, so I'll highlight that in green. So all of the entities' obligations not classified are as current liabilities. So long-term debt, borrowings from banks and other lenders. Other liabilities is miscellaneous liabilities identified in the notes to financial statements. So shareholders' equity of a company. So this is this part right here. So let's explain that. It's the financing provided by the to the corporation by both its shareholders and the operations of the business. Creditors are entitled to a settlement of their legal claims on the corporation's assets before the shareholders even receive a penny. So make sure you know that the creditors are entitled before shareholders receive their money. Shareholders, they invest in a company because they expect to receive cash flow through dividends, which companies give dividends in stocks and all of that, or sell their investment for future or more money. Shareholders' equity of a corporation includes the following: 1. Contributed capital, 2. Retained earnings, or 3. Other components. Contributed capital, this pretty much means that capital that results from shareholders providing cash, sometimes other assets to the business. Shareholders receive shares as evidence of ownership from which they provided cash. So retained earnings, the accumulated earnings of a company that have not been distributed to the shareholders as dividends. Most companies that operate profitably retain part of their earnings for reinvestment in their business. The other part of earnings is distributed as dividends to shareholders. So 3, what types of business activities cause changes in financial amounts? So any event that is recorded as part of the accounting process is called a transaction. There are 2 types of transaction events. We have 1, external events. So this is the exchange between a business and external parties, typically entailing assets, services, or promises to pay. And then we have internal events. This encompasses adjustments related to the use of assets and operations such as depreciation. And this is internally in your organization. So an account is a standardized record that organizations use to accumulate the monetary effects of transactions. 4, how do transactions affect accounts? Business decisions involve an element of risk or uncertainty. Business managers should understand how transactions impact the accounts on the financial statements. Transaction analysis, this pretty much means the process for determining the effects of transactions. The principles of transaction analysis. Transaction analysis is the process of studying each transaction to determine its economic effect in terms of the accounting equation. And our accounting equation is the very simple: assets must equal liabilities plus shareholders' equity. So the accounting equation, like I just said, is assets equal to liabilities plus shareholders' equity. Every transaction affects at least 2 accounts. It is critical. Let me highlight that because that is every transaction affects at least 2 accounts. It is critical to correctly identify and classify these accounts and the direction of the effect, an increase or decrease in those accounts. Note, signing a contract involving the exchange of promises to perform a future business transaction does not result in a transaction. So dual effects, it's every transaction has at least two effects on the business accounting equation. This is what I highlighted here in green above. Every transaction affects at least two accounts. The business both receives something and gives something in return. So let's say if a customer gives cash, which is an asset, to the company, that company now must give something in return because there's a reason why that customer provided cash, and it was probably for a service or a product that it in return is needed to provide. So how do companies keep track of account balances? To handle the multitude of daily transactions that business generate, companies establish accounting systems. So start of the period, you have to analyze transactions, you have to record journal entries in the general journal. I don't believe we're going to be doing many journal entries in these future chapters. 3, post amounts of the general ledger. At the end of the period, you have to prepare a trial balance to determine if debits equal credits. Adjust revenues and expenses and related statements of financial position accounts. 6, prepare an adjusted trial balance. 7, prepare a complete set of financial statements and disseminate into users. 8, close revenues, gains, expenses, and losses to retain earnings, record it in the journal and post it to the ledger. So the direction of transaction effects. Transaction effects increase or decrease the balances of assets, liabilities, or shareholders' equity accounts. To reflect the transaction effects, we need to structure the transaction analysis model, which we call the T model. So this increases in assets accounts are on the left because assets on the left side of the accounting equation. So A equals liabilities plus a shareholder's equity. Increases in liabilities and shareholders' equity accounts are on the right. So let me highlight that actually. So increases in assets are on the left. Increases in liabilities are on the right. So debit equals the DR. It's the left side of the T. So just the T is right here. Hopefully you guys could see this. But this is one T. This is another T. Another example is just right here. It's just separating debits and credits, but since the way we separate it looks like a T, we call it the T model. And so those are your examples of the T models and the use of debit and credit. So assets, like we said, increase in assets go on the left. So let's say a customer were to provide us with cash, then we would debit assets since our assets of the company increases. But then from that, we must also increase and credit liabilities because we now have to provide a service or a product to that customer. And just the same thing, let's say if we were to owe a customer money or cash, let's say for this example, we would credit assets since we're losing cash, and then we would debit liabilities because providing cash was a liability before since we provided or something was needed to provide that customer. So analytical tools, the journal entry. Journal entry accounting method used to record the effects of a transaction on various accounts using the transaction analysis model. So that's pretty straightforward. It's not very too important. How is the statement of financial position prepared and analyzed? So 1, business create a trial balance spreadsheet first for internal purposes before preparing and reporting financial statements. So you could see a trial balance. This is just for internal purposes to see everything, how your cash, your assets all here are going. Then you have your current assets, you have your non-current assets, your liabilities on the bottom here, and you have your contributed capital, which is your equity, shareholders' equity, and you have your debits here, your credits on the right side, and you always want to make sure these equal each other. So once you do that, two, you want to make a statement of financial position, which is prepared from the trial balance used for external users. So let me highlight trial balance is internal. Statement of financial position is external. So this is pretty much it. It's a much bigger thing. So you can see January 3rd, 31st, 2021, January 3rd, 2021, the difference in assets. And then you could see the heading is a lot more easier to read. That's because it's for external users. So that's pretty much it for chapter 2. Thank you.